Once again, thank you for everyone to whoever contributes and completes the application process and with Equity Builder and Housing Our Workforce. Welcome back to our repeat member institutions, and also welcome to the new participants. These are great programs to help your borrowers sustain successful home ownership, and we are looking forward to working with you this year. So we do have a packed agenda, and we're going to really go over the enrollment process, soup to nuts. We're not going to be getting in the weeds with the actual online platform. So if you ever do have questions when it comes to the platform, it's just better to reach out to myself or the EVP HOW team. I will say my name is Caitlin Mulhern. So I joined the bank a little over 4 years ago. I am the homeownership set-aside programs manager. So this will be my 4th round running this program, and prior to my joining of the bank, I actually used to work at a small organization that utilized the Equity Builder program. So when it comes to the residential lending side, I have a very diverse background, and I can answer a lot of questions that you might have about this whole process. So when you're talking about both our programs side by side, the Equity Builder program is our oldest program. It started in 2003, and it is our regulated program within the Federal Housing Finance Agency. All the federal home loan banks must provide affordable housing programs, and particularly a set aside specifically for home ownership. So EBP is for income eligible home buyers toward down payment and closing cost assistance, and if it entails some rehab of the purchase of a property. And like I said, it is a regulated program, and since 2003 we have administered almost 49 million monies to home buyers, and this is always counting because these stats typically are from the end of last year, but we are still funding disbursements, and we've assisted a little over 4,200 home buyers. So it's had a large success rate. And the Housing Our Workforce program, this is a voluntary program. It's a spinoff of our EBP program. We started this in 2019. It was a 3-year commitment for voluntary, but it's been so successful that our board of directors actually approved to continue it for 2022. And since it started in 2019, we have dispersed a little over 5.6 million, and we've assisted 421 home buyers. I like this slide the best because when you're looking at how do you benefit from this program as an organization, but then also how are your home buyers, this is a great thing to share, especially with your sales staff and originators, because when you're talking to home buyers, the key selling points is this is an opportunity to bridge the gap between a mortgage and purchase price for these home buyers. Maybe they can have a lower loan to value, maybe a lower debt to income ratio, and putting them in a greater equity position. It's for down payment and closing costs. For the Equity Builder program, the Housing Our Workforce program is for down payment only. We'll talk about that later in the presentation. And this is also potential savings for these home buyers to, not dip into their savings or taking loans against their 401k. Hopefully this is a way for them to get into the housing market. As we know, in New England, we are super challenged, not only with inventory, high interest rates, and these home buyers, trying to be able to take that leap into the down payment of buying a home. When you are talking about you, the member, because technically you are our customer and you're working with the home buyer, so you're our eyes and ears on how you are operating these programs, but this is a great opportunity for you to expand business development opportunities. We see a lot of people who pair EBP in their CRA considerations. It's been very successful, and this is an opportunity to work with these home buyers for down payment and closing cost assistance if they lack these funds. The beauty of it too is that you can pair our grants with any other down payment assistance programs. For example, if you're state housing finance agencies, municipalities, etc., you can layer us. We'll sit in any lien position. We are not lien sensitive. We sometimes tend to see ourselves even in fourth position. You can layer us with anything. So that's the friendly selling point when you're working with home buyers, especially because in the real estate market, they are up having a barrier of working with a realtor, and maybe having this grant program is something that, you know, they are saying it's an extra layer, it's an extra underwriting process. There's more flexibility in this program that people really give credit for. So these are the things that's really important for you to appreciate and understand. We, in addition to not being lien sensitive, it is income driven. We do not look at FICO. We do not look at back end ratios for DTI. We do not do asset tests. We do not care about loan to value. The goal of these programs is to be able to use these down payment assistance with your existing mortgage products. We're not asking you to reinvent the wheel. It's supposed to be complementary, and the extra layer is really just the income component. So we will get into that part later. One thing to also note, we do have a notation about other down payment assistance. So if it is an affordable unit or it has a deed restriction on the property itself, feel free to reach out to us, because if that has received affordable housing funds, that property might not be eligible. It doesn't mean that that home buyer is. So if you ever have that, just reach out. We are more than happy to look that information up for you. This is a great resource as well. It's located on our website. So this is comparing both of our programs, and ideally these programs are supposed to operate procedurally the same, with a couple of nuances. And you know, to go over the really key components, we'll take out the fact of the member application period has already concluded. So your organization has been issued the award to offer these programs, and now you're fulfilling the training requirement. So for EBP, the where it is income driven, the maximum area median income threshold is at or below 80%. We're going to get into how we define that in the presentation. And then for the HUD program, it's slightly over that 80% and up to 120%. When you're looking at the grant per household for EBP, we used to do 15,000. Our regulation has allowed us more flexibility to go higher. So we are now being able to offer 22,000. And hopefully, you know, yes, that does serve less home buyers in when you're looking at it from a pipeline perspective. But these costs of properties, wherever you are in New England, they're only going up, and our goal is to be able to provide these home buyers more liquidity when they are trying to purchase. For the HUD program, it is 20,000 with a 2-to-1 match, and we will talk about the match component if this program is brand new to your organization. We did originally offer the 2-to-1 back in 2019 at 20,000, and we did make some enhancements last year, and we are now reverting back to that exact original max grant per household and match parameters. So with that being said, we have increased the grant, and with that, we have increased your organization's maximum funds that you can offer. So for EBP, it is 222,000, and for HOW, it is 150,000. Something to always note, especially from a marketing standpoint, especially with loan origination staff, these funds are never guaranteed. They're always on a first come, first served basis. And that is just your threshold for your organization. That, for example, if you give 22,000 to 10 home buyers, you're maxed out for the year. If, you know, that is how it works. So it's a lot of teaching when it's in your organization, and our marketing materials do have that information spelled out too, and just something that you don't want to overpromise these funds. People probably say that they do go quickly, but I will say the last 2 years, because of the housing market becoming rather costly, we've made some streamlined enhancements that the anticipation is that these funds hopefully will not go as quickly as they have in the past. We want to allow as much equal opportunity for all shapes and sizes of lenders to be able to offer our programs. So EBP is for down payment and closing cost assistance. And like I said, rehab is a component. We do talk about that in our presentations on how we define and document. For the HUD program, it is for down payment only, and we will get very into that part later in the presentation. HUD does have a maximum purchase price limit because this is for a higher income bracket we're talking about. It is on our website, and our online system does have all this front loaded in there, and it's based off the mortgage revenue bond limits. Feel free to check out that information on our website. You're taking the training. Every year your organization has to annually apply. It's not an automatic renewal. Your organization is a member of the Federal Home Loan Bank of Boston, and you are fortunate to be able to offer these programs to your home buyers. And hopefully this just only enhances your residential lending department. There is a disclosure. It is for both of our programs because maybe you're unsure if they fit in the EBP program or how, and more often than not, we see a lot of people that are really on that threshold. So it is for both. It's our Fannie Mae 1003, I will tell you. We don't look at Fannie Mae 1003s or 1008s. We don't want to look at that information. This grant program is specifically income driven, so that document is really everything that you need to see if these home buyers that you are interfacing with are eligible for either of our programs. It does have to be for owner-occupied primary residences, and for EBP, we have a regulatory requirement by the FHFA that the first 1/3 of your enrollments or home buyers has to be a first-time home buyer. We do default to the HUD definition, has not owned a home within 3 years, single or displaced homemaker. And if you ever have any complex scenarios where you are unsure if they fit into that first-time home buyer bracket, please reach out to myself and the team. We do encounter a lot of different inquiries and scenarios, and we're happy to work through that with you. HUD does not have that requirement. However, they cannot, if they have a primary residence, they cannot convert it into an investment property. It does have to be sold either prior to the closing of the new property or at a simultaneous closing, and we will look for that documentation. And any first-time home buyer in general has to complete the education and counseling component. If they're not a first-time home buyer, they don't have to complete it. There is a 5-year retention period, and we do spell that out on our mortgage and notes. So there is a lien on the property. Your organization has to monitor these grants for that 5-year duration. For EBP, there is a component or a layer, if you will, that your organization has to offer a concession or an incentive to the home buyer. For example, maybe a waiving or reducing fees, a general lender credit, below market rate, things of that nature. And if you ever have questions about that, all that information can be found in our procedures, what is acceptable. HOW is the only program that has a down payment match requirement. So when you're looking at the workflow, how does this operate? How do you get home buyers in the door, and how do you navigate through this entire process with either of our programs? So the first step is you're working with your home buyer, whether they have a PNS or you're working on pre-approval, pre-qual. You're going to work through, and however you operate in your due diligence, you can access our EBP HOW disclosure, get that information from your home buyer to see if they are income eligible. Once you have a fully executed PNS and you have all your income documentation, that's liftoff. You are ready to go. You can then submit on behalf of the home buyer through our online platform, the community lending login, and we call our application for the home buyer an enrollment. So once you've done that, you're going to work through the fields, you're going to complete the online income calculation, and then the next step will be that once we've received everything, we're going to do our 2-tier review, and we're going to see if everything ticks and ties and they are income eligible. We do advise 15 business days. Naturally, we do try to turn these files around rather quickly, but given peak home buying season, we have a variety of housing community investment programs here at the Federal Home Loan Bank of Boston. So there might be a little bit of time where there could be a delay, but we just like to set you up for success when you're communicating with your home buyers, because we do not directly interact with them. We will always default to you, the member of our institution. So if everything ties out and we have approved the enrollment, your organization is going to close on your first mortgage financing. So you are table funding the grant, and this is pretty common in a lot of down payment assistance programs throughout New England. And then you're going to execute our mortgage and notes for either the Equity Builder program or Housing Our Workforce. You're going to work with compiling all of your post-closing documentation. You're going to go through that community lending platform. You're going to submit the requests for the disbursement or the reimbursement for the grant, so that way you can reconcile and satisfy your accounting department. We're going to look through all the required documentation. Allow us 20 business days before we fund your ideal way account. We say that just because, especially if we have a lot of disbursements at month end, and we're in a little bit of a holding period from month end reconciliations. But we do try to, once again, turn those files around a lot quicker than normal. And it also is a 2-tier review. So we do have 2 analysts who do complete the first reviews of the enrollments and disbursements, and myself and my other colleague, who is our HCI programs manager, she also does complete the compliance and second review with myself. So we do have a good team of 4 looking at all of these enrollments and disbursement transactions. So funding periods. So this year's funding, we have 3 funding periods for both programs. They are going to be released simultaneously. The first release will be April 1st, and then we have May 2nd and June 1st. So this is at the sole discretion, and we do not have the final number at this time. We are working on publicizing our organization's 10Ks, but just to give you an idea of where these monies come from, because a lot of folks will say, the money goes quick, is there any way to add funds? So we're required for Equity Builder program to take 10% of our year-end earnings and put that into affordable housing. So within the AHP umbrella, whatever that dollar amount is from that 10%, we then take 15% and we put that to EBP specifically. So every year it fluctuates, and every year you might see some restructuring of these funding periods. Back in 2017, we had, I think, only 2 funding periods. We weren't turning files around within 15 business days, and we want to make sure we're providing you great customer service. Sometimes we've spread it out a little too thin, and funds were going within minutes, and hopefully looking at the purchase market, and we do as much analysis as we can to try to predict when this will be the most appropriate amount, but it's always on our sole discretion. And then for how, it's voluntary, so this is a separate pool of monies. It's something that we are looking to hopefully continue to sustain, but also just to know, with the pandemic and everything, a lot of your organizations are swimming in liquidity, and the way we obtain our revenue is from advances. So that's why you might see the total allocations a little lower last year. I'm hoping in this year that it will be in trend or a little bit more than what we had last year, but something just for you to appreciate on how do we get this pool of monies. And like I said, it's always subject to change, but also if the monies are not exhausted, they continue to roll over. And just to give you an idea that we probably had funds until July and August for the EVP program, and for how I would say more on the later August side. So just to kind of give you an appreciation where last year we sat. So it's really important when you are trying to determine who should be the contact for your organization, because they're going to receive all the notifications. So it's essential that you have that perfect fit. We can update these contacts throughout the year in case you have turnover, or if for some reason, maybe at time your organization applied to offer the programs, realize maybe that's not a good fit and we'd like to go a different direction, you can always reach out to us. But it's important that these people are kind of your gatekeepers, if you will. They're the eyes and ears for all people within your organization, as well as home buyers. They really should be seasoned in these programs, in addition to receiving all of the email correspondence, and then working on, coordinating your organization's internal procedural workflow, if you will. So, making sure that people like loan officers are, fully aware of how these programs work. Same with operations staff and closers and post closers. So, you're administering how you're going to operate this within your institution, and we just kind of provide some best practices, if you will. So some reminders for your organization: you're already taking the enrollment training, and if for some reason some people can't take live, we are going to offer the recorded webinars. You have to submit through our online portal. We will not accept any documentation via email. So that is how you're going to submit that request for these home buyers. Our housing front-end debt-to-income ratio maximum is 37%. Something to also take note that is in our procedures, we will go above the 37%, providing we have compensating factors. For example, here are some strong contenders that we like, because we don't look at FICO. That's not really a compensating factor for us, or long employment history. We would say, what is the monthly rent that they're paying now? Is it either going to benefit them purchasing, or is it within line and they can sustain this monthly debt, or 2 to 6 months reserves? Or we don't look at back-end debt, but if for some reason you find that the home buyer only has a front-end debt or a very low amount of back-end debt, that's great, and we'll satisfy that as compensating factors. And we're a little lenient on that if it's 38%. We're not looking for all three of those. However, if you're at a 50 and your compensating factor is that we got an approved eligible from our AUS findings, or FHA will go higher and Fannie and Freddie have increased their threshold, that is not a compensating factor for us. So we might go back to you for some more information, just to really understand that the homebuyer can sustain home ownership. You're always going to be looking in your pipeline regularly. We recommend that for either EVP or HOW. If you want to decrease or increase any grant amounts, you can do that in the online portal as well. And we'll talk more about the requirement for first-time homebuyers. And we already talked about the member concession for EVP only. So when you're looking at these households, some important reminders: it is for primary residence, and that entails 1 to 4 family units, condos. It can be large complexes. It can be a 2 to 4 multifamily that was converted. Manufactured homes are also acceptable, as long as they are permanently affixed. Wheels up, axles down. Home buyer must take title. Just to kind of look at it from a P&S perspective, the property can have a deed restriction. It can be a short sale. It can be a foreclosure. We have no stipulations on anything of that nature. And there's a lot of flexibility in that property type, in my opinion. You're going to be executing that disclosure and going through the total household head count. We'll get into that part in another slide. A regulatory hard stop for the Equity Builder program is the homebuyer cannot receive more than $250 cash back at closing. And because we want these programs to operate procedurally the same, HOW also does have that component. The minimum down payment is $500. And something to note that for EBP, that is great, but for HOW, because it's a match component of 2-to-1, based on their contribution of their own funds, you're going to want them to put more down. Something to note that the earnest money deposit always has to stay in the transaction. It cannot come back. So if for some reason for EBP, for example, they put down more than $500 and then you realize that they're eligible for EBP, they can't undo what they've already completed. And like I said, the mortgages and notes get executed at closing, and education and counseling. So just some good takeaways when you're talking to your home buyers. So when you're identifying the households, when we're talking about the income limits, we do use the HUD income limits. And because of the way HUD operates, sometimes we have a tendency to kind of start our program a little before when HUD administers those limits. So if they, for example, I believe they have released last May for 2021, we will operate under the 2021, and once we are notified by HUD that they have switched and provided the 2022s, we will then default to that, and we will determine when we change over, and we'll provide notification well in advance once we fill that information with our email notifications and when you're logging into the community lending website. I have a question regarding the cash to close. If a borrower is having funds held by the bank, no actual cash to borrower at closing for repairs in excess of $250, is that permissible? Is this an escrow account if there is a rehab component? Because that is not considered cash back and access to us. This is literally just looking at the closing disclosure and seeing the line item cash to close on that. I hope that explains that. If not, feel free to talk offline to me, and I'm more than happy to talk about any rehab component for that information. So when you're looking at the households, we're different from first mortgage lending. You might have a borrower, and that might be the only person that you are looking at when you're qualifying from an income. We're compliance. So it's everybody who's going to live in the property. So for example, if you have 2 adults and a child, your mortgage only has 1 adult. We're looking for both adults' incomes, and we would classify that as a household of 3. We do include children in the household count, and if they are 18 or older, we do include their income. I'll get into that a little more. But to give you an idea before you're looking at the HUD income limits, and we'll go through an example of how we're looking at it on the HUD website, which also is how our system calculates and populates this information. So it cannot exceed the AMI limit. And that's why we need a purchase and sales agreement. We can't accept offers because this is a very both programs actually, that it's used very heavily. We can't entertain offers. It has to be a fully baked purchase and sales because everything is based off of the income guidelines. And that's our biggest regulatory hard stop. We can't make exceptions at all. So if they don't meet one program, maybe they can work in the other. And if your organization offers both, that is a great marketing strategy, in my opinion. As I mentioned, that if a household member is 18 years or older, we do include their income. If they are a full-time student and you have documentation that they are, for example, transcripts, whether they're in high school or college, we cap off that annual income at $480. That is in our income guidelines, so rest assured that there is a source out there for that, but I want to at least give you that information. And just making sure that when you are uploading everything, that you're reviewing all the income sources. We're all in for income. We are compliance. When you're looking at job history and you see that somebody doesn't have that Fannie or Freddie 2-year, underwriting requirement of like season overtime, that doesn't matter to us. We are 12 months perspective. So it's really important for you to like layer this as an additional underwriting component when you're looking and determining if somebody's income eligible. And when you are submitting these home buyers, it's all income-based eligibility, and it's for that home buyer specifically. So you can't swap out a home buyer. You can, if there's a situation that a property falls through and they do have one in the queue, you can always talk to us, let us know, submit that new P&S information, and we can just determine that it's within the same AMI location. But something to remember, I do have a request to go over acceptable lending areas. So we lend all throughout New England. So if your organization has a lending footprint outside of where you're located, as long as it's in New England, you are able to offer this program. So if you have any questions about those types of things, feel free to ask, but it is all through New England. So the documents that are required at enrollment, the EBP HUD disclosure, we do have to receive the 2022 version. So it's really important to purge your organization of all old documents. We can't accept it because every year we do make some enhancements, especially when our regulatory guidelines change. We need to make sure that we're using the most current version, and it needs to be executed by the home buyer, and you need to have all household members identified. So a good takeaway is really to have your loan officers working with the home buyer, going over the parameters of the program, and really asking the questions that are on the document and letting them know that we are all in for income and everyone who lives in the property. So if, for example, you have that college student who's only home for a couple months out of the year, they're still a household member. If you have a situation of 50-50 custody of children, they're still considered a household member, so they are included in the head count. Can documentation for signatures of loan officer or a loan processor vary as long as it's within the same organization? So if you're talking about our disclosure, it is signed by all the home buyers and all adult household members. We do allow e-signatures as well as wet. We only have the loan officer, effective last year, signing the disclosure. We used to have also the EBP HUD contact, but we did away with that because we're at the point where that EBP HUD contact is validating and certifying that everything's true to their knowledge. So I hope that answers the question. And if you have questions about signatures, feel free to reach out. For e-signatures, someone's asking, do you require a date and time stamp? No, we don't, but if it's just typing in Microsoft Word and it's very evident that it's not an actual e-signature, you need to kind of take that into consideration, because we need something that it looks as formal as it can be. But we're allowing this flexibility because we do understand that people might be remote, and the idea is that you can potentially maybe sync up our disclosure with your LOS system and provide that e-signature type of document. And I have another question about college students. How do we document income for college students that work in the summer only? If they are a full-time student, we cap them at an annualized amount of $480, regardless of what type of job they have. If they are not a full-time student and they work the summers, I would recommend a Fannie Mae 1003 for that situation, because you might be challenged with looking at that seasonal employment, and I would default to seasonal employment income guidelines. All right, this is good. We have a lot of questions. If a first-time homebuyer is self-employed and needs a non-occupant co-borrower's income to qualify, is it possible to qualify for EBP? So we do permit non-occupant co-borrowers if you need that to qualify because they are newly self-employed and you don't have your satisfactory self-employment history. We don't include the non-occupant co-borrower's income. We do not include them in the household head count. However, if you know that this home buyer is receiving money from the non-occupant co-borrower to satisfy the monthly mortgage, we consider that a form of income. I'm happy to talk offline about that. We do have a section in our income guidelines as well as our procedures on how we operate with non-occupant co-borrowers, and we just need some documentation that they're not residing in the home, they're only assisting in qualifying for your first mortgage, etc. And another question about full-time students. So we do have a whole section on this in our income guidelines, but if a full-time student is not working, do we still need to include that minimum in the compliance? If they're not working, they're going to be signing a zero certification of income. So we would not cap off at the 480. So that is a good question. And we do talk about the zero certification of income, if that's applicable. So something to note that's on here, that is very specific about they have no income. So those are the things that when you're looking at it and asking them, there are a lot of things like Instacart, or people are getting paid from cash apps like Venmo and Zelle and things like that. They might have a side business on Etsy, things of that nature. That's income. So when they are signing a zero certification of income, you really want to make sure you're having that conversation with them. They have no source of income whatsoever, because that is our compliance document saying, I am living in the property, but I have absolutely no income. So when you're looking at the income documentation, just to take a step back from the general requirements, all of our required documents are defined in the income guidelines, and they need to be dated within 45 days of the enrollment because we're 12 months prospective. So for example, pay stubs, that's pretty common. Make sure it's dated within 45 days, but say you have SSI and you don't have the current award letter, we can't just take that 1098 and use that to calculate. We need that current income. We only require tax returns or IRS transcripts for people who are not W-2 wage earners. We used to in the past, so we have eliminated that as of last year. And just to note that we can't accept any documents, once again, through email or encryption. It needs to all be submitted through the portal. Another question, just back to the full-time student. How do we verify a household is a full-time student? I would say the transcripts, whether they're college or high school, would be appropriate. I also do want to direct you, if they are the head of the household and they are a full-time student, we do not consider that. They need to not be the head of the household. We're very specific, and I strongly encourage to look at that section in our income guidelines about college students. And the reason why we cap it off at 480, because one of the questions is, what if they make more than 480? is because if they're doing a work study or they're receiving an education and, they have a part-time job at a grocery store, but they are, getting their medical degree, they don't know what they're going to be making. We can't predict the future. They're just working to be able to, sustain food and shelter. So that's why we cap it off at the 480, and that's defined by HUD actually. So I like to tell people when you're looking at the income guidelines, we're a hybrid of HUD, Fannie Mae, and Freddie Mac. And we are not, and one of the comments is that recent tax returns, that there's a certification in the online system. There is not. We did update this recently, so it is only applicable if it is for anyone who's not a W-2 earner. So some other documents that are required at time of enrollment: the P&S, it should be legible, it should be fully executed, it cannot be outdated. If that is the case, please get an addendum. You need to give us within 15 business days, because that is how we are going to complete our due diligence in seeing if they're income eligible. So if you're not giving us that 15 business day, you're putting the home buyer at jeopardy. So the goal is we'll do the very best we can, but we cannot make any guarantees within that 15 business day mark. And when you're in the system, it's actually going to build out when you say, what is your closing date? And if you don't have the 15 business days, it's going to tell you that you can't proceed. So that's another indicator of getting that addendum and having that conversation with your borrower. If for some reason there is some unusual income, you can do sign and dated letters of explanation or email. We say that that's not a requirement. But if it, for example, they have a very interesting income stream, especially due to COVID, we are seeing some of this, and a lot of organizations have asked us questions, especially about first responders. Maybe they historically have overtime, but the last 2 years, it's showing a very extreme high history, but that's not going to be how it is. A lot of these workers have been mandated to work extra, and it's not an option for them. So if you have complicated situations like that and you really feel that the income that's being calculated in the system really doesn't sync up, I recommend sending an email with the information, with the scenario, not the documentation, and then having a conversation between one another and making sure that we're getting the full picture and we're really not eliminating somebody who potentially really could use this program. We have a lot of questions about income. Tax returns aren't required for first-time homebuyer status. The answer is no, because we have a first-time homebuyer certification within our EBP HOW disclosure. It is on page 8, and that is how we determine it, just because the tax returns with all the different tax laws kind of eliminated that. So if that document is signed and executed, that is them certifying that they meet that definition. Can you confirm if we are required to obtain most recent tax return? Oh, I already covered that. Sorry about that. And when it comes to the first-time homebuyer, is the 480 monthly or annual? It is annual. So when we're looking at the income calculation, it's really important to do a manual before you submit it through the online system. The system really is a paint by numbers. I know some people say that it's intricate and a little complex, but when you kind of really look at the logic of how our online system is layering that we are 12 months perspective, for the most part, it does calculate it out very accurate. But if you have some interesting scenarios, for example, that maybe they haven't been at this job since January 1st of this year, or they took a leave of absence, things of that nature, you might have some challenges with calculating the income, which is why we always recommend doing a manual, because that way, when you're looking at it, you can hopefully work on how to submit it. And if you ever run into instances, you can reach out to us and we can give you some best practices. But doing it manual is extremely important, because we are all in, we are prospective, we include overtime, we include bonus, we include commissions, any of that additional W-2 wage income, we're all in. The only time we'll exclude things of that nature is if that verification of employment, preferably a Fannie Mae 1003, has the likelihood of continuance checked off no. So we are very in line with Fannie and Freddie in that aspect. If there's a raise in the future, we are going to include that. We will look at from the date that you submit, and we will look at if the raise is in July. Say you're submitting this on April 1st and the VOE has that raise. We're going to factor in July, and we're going to calculate that out prospectively from the day that it is submitted. So they would have that rate from April 1st to July of, let's say, $5 an hour. And if they're increasing it $2 an hour in July, we'll then calculate that out later. And when you're doing the Fannie Mae 1003, Fannie Mae VOE, I'm sorry, it actually really does calculate how it would be on that document. We have taken that document and we have built it into our database to be able to factor in that. So that's why it's really important to do manual. And a reference to access our income guidelines. I really encourage everybody to read it. It does tell you all incomes. What do we use? What do we not use? We have a question about interest dividend income. If a tax return shows interest dividend income, should that income be included? And if so, should the tax returns then be provided? The answer is if it's over $100, yes, we do include interest and dividend income. And the best documentation would be the returns. We do have some other options in there if that is not applicable. If the section is not completed on the VOE regarding future raises, is it allowed to be blank? Yes, we see that all the time. And we know that, especially the nature of your business even qualifying, that sometimes these verifications of employment do not come back in its entirety. You really want to just kind of coach them to make sure that everything is completed to its best ability. But we do need year-to-date earnings, we do need dates, things of that nature, in order for us to calculate. I remember in my old underwriting days, I used to circle every box on that VOE, just really telling them fill it out. But from the raise part of it, if it's just left blank, we're going to take it as no, there is not a raise in the foreseeable future. And also, just to add to that, sometimes they'll select yes and they'll say cannot determine. If it's not there, we can't predict the future for them. So just something to kind of note too is that if there's not enough information and it's just checked off yes or no, we're going to have to go with what we have when we're looking at the rest of that document. Okay, so when we're looking at how are we defining AMI within the HUD income limits on their website. So the previous slide had the income, the hyperlink. So this is if you're looking at HUD, you're going to go into the most recent year of income limits. Like I said, right now they only have 2021. You're going to select the appropriate state, and then you're going to select the appropriate county, and then you're going to look at persons in the family. We do not go to family median income. So something to note, because some other programs out there do median family income. We count by household bodies. So if you're looking at persons in family, that's highlighted with a household of 3 in Boston, the 2021 annualized income, area median income is $90,950. That is for EBP. So when you're looking at how, you're going to want to determine they have to be $1 over what this example is. in order to fit for how. If they're not, they can't go into how. That they're better suited for EBP. So that's something to note, that even if they're under the threshold, they have to be over the 80 to be into that moderate income program. So when you're looking at the 120, the complexity is when you go on the HUD website, you say to yourself, where is there 120%? Because we do not have that on here. Because we are using HUD income limits, we have come up with that you do the same process. You're going to the current year, state, and then you're following that county or city. And because we need to get to that 120 projection, we're taking the 50 under the persons and family. You're going to times it by 2, and then you're going to times it by 1.2 to get to the 120%. So for this example, for a household of 3, they cannot exceed $144,960. And the reason why we're doing it this way is because the goal is that we want you to be able to offer both these programs if you applied for both. But if we use a variety of income sources, they're not procedurally the same. So this is why we had the logic of doing this, because if you looked at HUD, because they don't go over 80 because it's for low to moderate income, they have very complex NSP tables. It was thousands of fields. It was very difficult to navigate. But I can tell you, I have done research, and why we justify this is that a lot of the housing finance agencies, AMI limits, say they go up to 120 or 135, they're actually pretty in line with this. And we do see a lot of other down payment for workforce housing asking us where we get our income threshold. So a lot of people are trying to really allow that flexibility in conjunction with our program. Where on the website is the link to the income guidelines. So I have some resources at the end of this presentation. I'll be able to provide that. So when we're getting to the how match component, I know sometimes this can be a little complex and daunting, but we give you all this information just to make sure you really have an appreciation of what is the threshold, how do we define 2 to 1. It is for down payment only. It cannot be used for closing costs. And how do we determine this before time of closing? So when you're looking at the 2 to 1 match, the example that we provide on our website is that if a homebuyer contributes $10,000, they're eligible for $20,000. So it has to be their own funds. It can't be a gift. If they do receive an additional gift or gift to equity, that's fine. It cannot be in the 2 to 1 match. So say, for example, that $10,000, only 5 of it is the homebuyer's own funds. They're really only eligible for $10,000 HOW grant. So that's important to know off the gate. And then because it's for down payment only, and this is for a higher income bracket, a way for us to say, how do we set a benchmark that it's for down payment only? Well, it has to be the calculation of the purchase price minus your final first mortgage loan amount. I say final in case you are offering FHA and the upfront MIP, you're looking at the base loan amount, it needs to be the final. So when you take this other example that we have on our website, that the purchase price is $300,000, and that means that if you want the full $20,000 for this example right here, that your loan amount cannot exceed $280,000. This is because you guys are table funding these grants, so we need to have this due diligence done prior to closing, because we need to have that extra layer of the 2 to 1 match and that it's down payment only. And that's also another reason why we can't include cash to close, because you're table funding this grant and these closing disclosures are constantly fluctuating. And if we were to include that, there could be a potential that something has shifted, and we would never want your organization to be out the HOW grant. And unfortunately, we have had situations where people have had related parties and they've given back the earnest money deposit, or they have decreased it. It's really important to know that. And I know some people are saying, oh, if you take the 10,000 plus the 20,000, doesn't that really equal 30,000? We're not looking at it like that. It's two different layers that we're looking at. Step one is that 2-to-1 match. So you're looking at if they put 10, they get the full 20. And then when we're looking at it, it's for down payment only. We're just looking at it and setting that baseline, because you're looking at this at time of enrollment, but then when you close, these numbers move all the time. So this is why we are using the purchase price minus the final loan amount, because you're going to be putting that 20,000 on your closing disclosure, and that is going to the down payment. So hopefully that makes sense. We've been trying to do a stronger job at really articulating the why and the methodology, and I hope that was helpful. So if for some reason, one of the questions we're going to get into the next paragraph in this is that it has to be evidenced either on the purchase and sales agreement for the earnest money or prior to closing. So if for some reason you thought this home buyer was better suited for EVP, they're over, you have a conversation with them. Oh, you only put 500 down. They say, well, I do have money in savings, and I didn't want to tap into it, but if that's how I'm going to be eligible for a grant, I'll do it. An addendum can be executed. It just has to be prior to closing. And like I said, it cannot be matched. It cannot be based on that cash to close. We have a lot of questions about this. So hold on one second. All right. Oh, that's this isn't a question, but something also that is strong information, that if your state has any housing trusts, for example, I know Vermont does Champlain Housing Trust, and there's a lot of like larger grants for 50,000, 100,000. You can't count that in the match. And when you're looking at that, you really want to be careful when you're looking at that purchase price minus the final loan amount. We're still basing that calculation, but really make sure that they're not getting 250 cash back. And if you have that component and you're a little concerned and maybe you haven't used the HOW program, feel free to always run the numbers before you close these loans. We understand it's a partnership. We really want to make sure that you're getting the reimbursement of the original request. Okay, so for HOW, we do have home purchase price limits. As I mentioned, we take this from the average area purchase prices under the IRS mortgage revenue bonds. We did use the most recent one that we had available at time of working on the materials for 2022. Naturally, it's going to be based in 2021 because the 2022 home buying season has not occurred. You can visit our website or use this hyperlink. It will take you directly to it. Also, our online system, when you're in HOW, will actually show you that information. But if you're a loan officer and you're on the road and you really want to just check this in advance and you're not having time to log into the community lending login, here's how you do that. So when a file is in member action required, that means that we have looked at the file, whether it's in first or second review, and we still need some information. We're going to put it in member action required. That means that we still need some documentation from your organization. The monies are still reserved for that home buyer. However, we're missing information and we cannot make a determination of whether or not they meet EBP or how. So here are some examples of why we'll release files back. Like I mentioned, if you have a stale or missing pages from a P&S, or it's not even signed and it's an offer, we'll kick it back. If the EBP how disclosure is not complete, we will release it back. So if it's missing signatures, if they are a first-time home buyer and they didn't sign the certification, if for some reason all adult household members have not signed the document in the appropriate places, we will release it back. If we're missing income documentation that's in accordance with it, you know, that is, those are some examples. We do require this documentation to be submitted to us within 10 business days through the portal. On the 5th business day, our system will generate an email reminder of that you have outstanding items with us. And you do have to resubmit the file back to us. If there's for some reason a circumstance where you're unable to get it within the 10 business days, please just reach out to us. We're challenged with it. Some people kind of forget about these files, and if for some reason your organization decided to go another alternative route for this home buyer, you got to let us know, because you're holding up the funds that could be for another home buyer at another institution, or even one of your own for that matter, that really could benefit from these funds that's fully baked. And we do have the discretion to deny within the 10 business days if you can't satisfy the documentation. And I just want to say that our team does a great job at really looking at if documentation's missing things. We do understand that a lot of these borrowers are not cookie cutter. There might be a lot of back and forth. We do our due diligence and really make sure that we're really following the income guidelines, but we have a full appreciation of this individual home buyer and their sources of income. I just have another question I'm trying to go through. It's about the match component. Can they be brought to the closing and given prior to the signing of the documents? So it has to be, the 2-to-1 match has to be prior to the closing disclosure. So the cash to close cannot factor in that 2-to-1 match. So for example, we have had situations where an addendum will read an additional $5,000. Say they only put down 5 and you want them to get the full 20. We've seen addendums say $5,000 to be provided to the seller prior to the closing on such and such a date, or it's very specific that an additional $5,000 will be provided on June 28th, for example. So as long as we have that in writing before, and when you're looking at the CD at disbursement, we tie that out. So if you're telling us that they contributed $10,000 prior to closing to get the 20, we're looking at that third page of the closing disclosure at a disbursement level. If you have any questions about it, especially if your organization is new to how, please reach out offline. I'm more than happy to talk more about that, but I hope that answers your questions. Homebuyer education and counseling. When we are looking at the homebuyer education and counseling, you are going to look on our list. We have a drop down, and these are the resources provided. Online component is acceptable as long as it is through Framework or eHome America, through the bank's approved agencies that we have listed, CHAPA, HUD, and NISHA. If a homebuyer completes the online education through Framework or eHome America, your organization has to ensure that you complete the post-closing component. The bank will not permit any other agencies from Fannie Mae or Freddie Mac or MGIC. I do know that Fannie Mae is paired up with Framework, but they used to have a 30-minute, quick reminder, so that's not suitable, but we do understand that. And here's an example of a certificate that would be acceptable. You see that a home buyer went through framework, but they worked with MAHA to do the online component, and then they worked on the counseling with MAHA. A reminder that the training for disbursement is coming up in the future, and here are the dates that are on our website. We're going to talk about the 5-year retention period, and we're going to go over your monitoring requirements as well as the home buyer and homeowner. Here's who we recommend take it, and there also will be a recording for this as well. Thank you everyone for taking the time today. As I mentioned, I'm Caitlin Mulhern. I am managing both Equity Builder program and Housing Our Workforce. Our senior analyst, Kevin Ryan, you'll hear a lot from him. This will be his 3rd year reviewing EBP and HOW transactions. And we actually did just onboard a 2nd analyst, Jack Newton, recently in the end of February. And he will also be working alongside Kevin and my HCI operations manager, Livia Borg. You might see some emails from Paul at VAS, whether you've locked yourself out of your community lending or go to webinar dilemmas, and then our senior vice president and director, Ken Willis. And we did go a little over today, but I just want to thank everyone for the opportunity today. I hope this information was, helpful, and please reach out. We look forward to working with you. And the webinar for today will be available. It won't be available today. We have to go through the proper channels to get it to the website, but it will be in the near future. And the goal is to have all this information at your fingertips before the first release on April 1st. So thank you, everyone.